Just like the accounting for debt investments, the accounting for equity investments also has three types of treatment. However, the three types are entirely different from those of the debt investments. With debt investments, it was based on management's intention. Are we going to hold the security to maturity? Are we going to actively trade it? Or will there be something in between? Well, equity investments have no maturity date. Equity investments allow the holder to have voting rights and a say in the major strategic operations of the company. So the accounting treatment for equity investments depends on the level of ownership or the level of influence that the investor has over the company. The level of influence is deemed as determined by the percentage of ownership that the investor has in the investee. And that percentage of ownership is going to range from just barely over 0% to owning every single share in that company. GAAP says if the investor owns more than 50% of that investee, that they control that investee because they're the majority stakeholder. And when you have control or over 50% of the ownership of the company, the accounting rules are consolidation. And the good news is you've already covered consolidation in your advanced accounting class, and we don't need to cover it here. The two types of accounting treatment that we do need to focus on are based on whether the investor has little or no influence over the company, that is the investment, or whether it has significant influence. Over the investee. And GAAP gives a rule of thumb of ownership of about 20% as being that separation. When an investor owns up to about 20%, we say that investor has very little say over the strategic management, the major decisions of that company, and the type of accounting treatment is called the fair value method. And when the investor owns 20 to 50%, they have significant influence over that company, and the type of accounting treatment is called the equity method. This video focuses on the fair value method. So some rules that we need to keep in mind when we're using the fair value method. When the investee pays dividends and the investor is going to receive the dividends, dividends received are recorded as an increase to cash and an increase to dividend revenue on the income statement. That's going to differ in the equity method. Next point we need to know about the fair value method: changes in the fair value of the investment, those unrealized holding gains and losses. How do we account for those? They're going to be accounted for the same way that we accounted for them with trading securities. They are reported directly in net income. And sometimes you see the fair value method being referred to as FVTNI, fair value through net income. And the specific account that's used to track the income statement side of the journal entry for the changes in the fair value is called the gain or loss on investments. As you would expect, this is an income statement account. We are going to credit to increase a gain. debit to record a loss. And that's one side of the journal entry, is the income statement side of a change in fair value. The other is we have to change the value of the asset, the investment asset. And we don't do it directly to the investment account. In most cases, most companies are going to record increases and decreases to the investment in a separate account. An account is called the fair value adjustment account. And this fair value adjustment account is going to be reported alongside the investment account. So you're going to have the investment account reported at cost, and then the separate fair value adjustment account changing the investment account to bring it to its fair value. And that fair value adjustment account, if this is known as not a contra asset, but an adjunct account. Because the investment account carries a debit balance because it's an asset. The fair value adjustment also has a normal debit balance. In other words, if the fair value increases, we record a debit to the fair value adjustment account. And if the fair value decreases, we record a credit to reduce the fair value adjustment account. Okay, let's look at example 1. Record each of the following transactions for T-Pain Corporation, a coffee and tea shop. Transaction 1 says the company purchases 5% of the common stock of Bruce Springsteen Coffee for $1.5 million on January 1st, 2024. So let's record the entry to acquire this security at its cost, of course. We are going to debit the account investment in equity securities. At its cost of $1.5 million. This is an asset account, so let's just note that assets increase. The credit is going to be to cash. We have to spend the cash to get this investment, and so of course that's going to decrease our assets. Second transaction says on December 28th, TPC receives a $75,000 cash dividend from the investee BSC company. Remember, when we get dividends, what we are receiving is cash. And we record the dividends when we're using the fair value through net income method. We record the dividend into the income statement account, dividend revenue. Okay, so of course our assets go up and net income goes up. Transaction 3 on December 31st, 2024. The investment has a fair value of $1.45 million. Okay, so we see that there is an unrealized loss of $50,000. Rather than decreasing or crediting investment in equity securities for that $50,000, we're going to credit the fair value adjustment account. For $50,000, the decline in the fair value this period. And the other side of that journal entry is going to be the loss on investments. So when we debit an income statement account, we're going to decrease net income. And this credit to the fair value adjustment is going to decrease our assets. Actually, before we get to 4, I want to look at what would be reported on the 2024 income statement and balance sheet. The balance sheet reports the investment in the equity security, of $1.5 million. And then we would have a negative balance in the fair value adjustment account. The credit balance reduces the value of the related asset. And we have our investment at fair value, or net of the fair value adjustment, of $1.45 million. The 2024 income statement is going to report the dividend revenue of $75,000, and the loss on investments of $50,000. Okay, now let's move on to the next fiscal year, 2025. On January 5th, TPC sells its investment for $1.446 million. When we have a sale of investment, we record two separate entries. The first entry is going to bring that asset to its new fair value. Okay, I'm going to set up a T account here for that fair value adjustment account. At the beginning of 2025, or what did we end 2024 with? We ended with a credit balance last year of $50,000. So this is our beginning balance, or our balance on January 1st, 2025. And what do we want it to be? We want our fair value adjustment account to have a balance of $54,000, the difference between the cost of $1.5 million and the current fair value of $1.446 million. So we want the ending balance to be a credit of $54,000. This is our required balance right before the sale. And what do we need to record as our entry? We need to record a credit of $4,000. So I'm going to leave room for my debit, and I'm going to credit the fair value adjustment account for $4,000. And what's the other side to that entry? It's going to be the loss on investments for $4,000. Of course, this means net income decreases and assets decrease. Okay, but that's just one of our two journal entries for the sale. The next is the actual sale of the investment. We receive the cash of $1,446,000, and then we sell the investment. So we take the investment off of the books. I'm going to leave a line for another debit. I'm going to credit to take the asset, investment in equity securities, off the books at its cost of $1.5 million. And then I see I need a debit of $54,000 for my equation to balance. And what is that going to relate to? I need to remove this $54,000 fair value adjustment, because if I don't have the related security, I shouldn't have any balance. So I'm going to debit to remove the fair value adjustment account. And once I do that, the fair value adjustment account will now have a zero balance, which is exactly what I want. What will the 2025 balance sheet, let's say the 12/31/25, the balance sheet reports nothing because we've sold the investment, and the year ended 12/31/2025, the income statement is going to report the loss on investments of $4,000. All right, let's move along to example 2. The investments of Harlan Enterprises included the following cost and fair value amounts in millions. So the company has 4 different investments here. The shares of A Corporation were sold during 2028. We are in 2028 as we're doing the accounting. So item 1 is record the entry for the sale for A Corporation shares during the year. Let's start there. Let's do the same thing we did for the last journal, the last example. So for A Corp, before we record the sale, let's record the adjustment for the change in fair value. right up to that moment of sale. Okay, so the cost of A shares was 20 million. We started 2027, or sorry, we ended 2027 with how much in the fair value adjustment account? The fair value was 14. How did we get it there? We had to have recorded a $6 million decrease to the fair value adjustment account. So we had to put 6 on the credit side for that decrease. And this was our beginning balance in 2028, this year. And then the shares were sold for 15 million. So we had them worth a net 14 million. We sold them for 15. So right before the sale, we want to have an ending balance of -5 or a credit of 5. This is our required ending balance. So how do we get it there? We need to record a journal entry to increase the fair value adjustment account for 1 million. So I'm going to debit fair value adjustment for 1 million, and I'm going to credit gain on investments because I started the period with the investment having a fair value of 14 million and I ended it with they're valued at 15 million. So I capture for this period, I record a $1 million gain. And then immediately we record the sale. Now that we've brought it up to this fair value of 15 million, record the sale. Receive cash of 15 million. Take off the investment. Credit to reduce investment in equity securities at its cost. These securities cost 20 million, so let's take that out. Credit 20 million, and that difference is going to be a debit of 5. We're removing this $5 million ending balance in the fair value adjustment account. Okay, so what did that, let me go back to this first entry. The debit to fair value, this increased assets. The gain increased net income. And then here we have increase to assets. The debit to fair value adjustment increases our assets. And then the sale of a credit to our asset account is going to decrease our assets. So what do we have here? We have a net increase, a net flat here with a $1 million increase to assets and net income because of that change in fair value. Item 2 says record the entry for the change in fair value of B Corporation shares. So we're still holding on to them. We bought them at 35 at the beginning of 2028. Fair value adjustment account had a 0 balance. We need to report this $2 million increase in fair value into the fair value adjustment account. Okay, so increase the fair value adjustment account by 2 million. This is going to increase assets. And an increase in an asset is going to be recorded as a gain on investments. And that's going to increase our net income. Okay, so we want to start tracking the fair value adjustment account. We've debited to increase it by 2 million. 3, record the adjusting entry for the change in fair value of the C Corporation bonds. C Corporation bonds were purchased this year. We put them on at 15 million. By year end, they've lost 1 million due to changes in fair value. So we need to record that loss of 1 million. We're going to credit the fair value adjustment account for 1 million if I want to make a T account here. Put in that 1 million, and then we're going to debit loss on investments. What does this do? This is going to decrease net income and decrease assets. 4, we're looking at D corporation shares. D corporation shares, they cost 45 million. Last year, in 2027, they increased by 1, so we have a beginning balance in 2028 in the fair value adjustment account, a debit of 1, and we need it to be a debit of 5. Our ending balance is going to be a debit of 5. So I'm going to use a T account over here on the side. The beginning balance is a debit of 1. We have a required ending balance to get it to 50 million. We need an ending balance in the fair value adjustment account of 5. So what do we need to record to get it there? We need to increase or debit the fair value adjustment account by 4 million. The other side of that entry is going to be gain on investments of 4 million. So it's going to increase our assets and increase net income. Item 5 says, what would the company's balance sheet report at the end of 2028 as investments in equity securities? All right, so we sold A Corp, so we're going to have nothing. Our B Corp, we're going to have, well, we know the total investments. These are equity investments, so they're all going to be at fair value. We need to see the total at 101. But what are we going to have in terms of how much in the total investments and how much, what's our balance in the sum of all of the fair value adjustment accounts? And this would be our investments net, or investments at fair value when we add these two. Okay, so what is the balance in our investments account? We sold the A Corp, so we don't have those. Let's add up the cost of the B Corp, C Corp, and D Corp, 35, 15 plus 45. And the investments are valued at 95 million. And what's the total amount in all of our fair value adjustment accounts? A Corp, we had the 5 and then we sold them. So we ended up recording a credit to 5. We have no balance in the fair value adjustment account for A because we sold the investment. For B, we have a $2 million debit. For C, we have a 1 million credit. For D, we have a 5 million debit. So that's going to net to a 6 million debit, or we're going to add 6 million. And at fair value, that gets us to 101, which is exactly what we had expected. What would the income statement report as net gain or loss on investments? It would be the total gain or loss for each of these. So we had, in 2028, we have the gain on investment of 1 million, a gain on investment here of 2 million, now we're up to 3, minus 1 for this loss, plus 4 for this gain here. And that's going to get us to a total gain on investment of 6 million.